I practiced for a couple of years as a lawyer, but quickly realized that I was better suited to being on the other side of the transaction. So I really enjoyed the cut and thrust of the entrepreneurial world, not being a cookie cutter salesperson, but really trying to make sure that what you have to offer is relevant for that person. And you do that over and over and over again. You learn what the common objections are, and then you tweak your product to suit what the market wants and needs.
Right.
Rapport building at its core as a starting point, but then you run a good structured meeting, and then you have very good follow-up. You deliver what you say you're going to deliver, and then you do it again and again and again.
Hello and welcome to another episode of Ways to Wealth. Today I am happy to be joined by Dave. Dave, why don't you give us the TLDR on who you are and what got you here?
Awesome. So Dave Insull, thank you very much for introducing me onto the podcast. I'm a father of three, first and foremost. Live in Devonport, Auckland, after being in Hawke's Bay for 6 years, so relatively new back into the city.
Yep.
By way of background, I trained as a lawyer and did an English literature degree, which I really enjoyed, not so much the law.
Yeah.
And then practiced for a couple of years as a lawyer here in Tamaki Makaurau, but quickly realized that I was better suited to being on the other side of the transaction. So I really enjoyed the cut and thrust of the entrepreneurial world. I helped build a business called 90 Seconds from 2009 to 2015. We scaled that into multiple markets. So Auckland, Sydney, Singapore, Tokyo, London was the growth of that business. And we raised our Series A from Sequoia Capital out of Singapore. And I left that business. I sold down my shareholding and went into a different company called Cover Genius, which is an insurtech. Google it. It's an amazing company. I was their first sales hire living and working from the UK. So I got to do my OE within that startup experience.
Yeah.
That business had a lot of the usual startup starts and stops, but quite quickly found its groove. And within 3 years, it was unicorn status.
Yeah.
And I had a great time learning a new industry, living abroad, and then birth of my second child, moved back to New Zealand, bought a 15-acre lifestyle block in Hawke's Bay, planted lots of natives, ran a wedding venue, and realized that slow pace of life I wasn't ready for. So mid-COVID, set up an Australasian VC firm called Afterwork Ventures with 4 partners based in Sydney, myself being the New Zealand partner. We raised $24 million during COVID to deploy into early stage tech. That's when I first met you, Charlie, when you were growing Gembot and participating in the StartMate program.
Yeah,
perhaps
some random StartMate program thing. I can't remember what it was, but we'd literally just got going.
That's right.
And then
I loved investing. I loved tech. So I think when we crossed paths, I was super interested. And then from there, we actually lost our house in the floods. Cyclone Gabriel took us out, 10 foot of water through the kitchen at 3 a.m. My 3 boys and my wife and I fled to the hills behind our home. And in that,
was it a 2-story home?
2-story home.
So you were upstairs when that happened?
No, we chose to get out of the property because the floodwaters were coming up so fast.
Right.
So that was like a stop-go moment in Hawke's Bay, and we ended up investing in Extraordinary, which is the latest venture. This is a payments technology firm based in Takapuna in Auckland, which I can talk more about later.
Yeah.
But the business has been going from strength to strength, so that really drove the move from Hawke's Bay to Auckland. And I'm sort of 2 years in, leading revenue and growth for Extraordinary, and that's my TLDR.
I like it. I think I want to dig into some of your sales roles and your sales capabilities in early stage, because I think that's heavily missed and underappreciated in the startup lens and startup world. And I'd like to learn a lot about that, because that's obviously the phase we're in as well, is obviously growing and building that revenue base. And as a more technical kind of focused and product focused founder, you kind of sometimes may not appreciate what goes into actually selling, but also scaling your sales operations and making it work. And I think a lot of people could learn from that. Sales cures all in many cases. But I really want to know, and I guess I do want to know about the Cover Genius kind of saga, because that seems to be like a really interesting part of your journey. But when you were basically practicing law, did you have like an aha moment about like, get me out of here, get me into entrepreneurship, or was it earlier that you knew that you were an entrepreneur by nature?
Oh, definitely earlier. I had this experience at Otago University in my 5th year where I had an option to get a $7.80 an hour job on the ports, lugging stuff from A to B, or doing something for myself. And it was that sort of stop-go moment where I was like, I'm not doing that job. I've got more skills, more to offer the world. So that afternoon I went into the computer lab and I used Photoshop to design a 1-page flyer and designed a small brand called Friday Fruit Box, which lined up with my work week, my uni work week, where I didn't have lectures on Fridays. And my idea was that I would go door to door and sell these $20 fruit boxes to the wealthy areas in Dunedin and then deliver the product on Friday. And it was a subscription-based model. So I went out that afternoon and sold 20 boxes to 20 different families. And on that Friday, I had to work out how to buy product wholesale and then deliver it. And it was easy. And I delivered it and I sold another 20 the following week and another 20 the following week. And I had a subscription model of 80 families that I was delivering fruit to every Friday.
That's nuts.
12 weeks later, I sold the business and traveled through Europe. And it was an idea to exit in 12 weeks. It wasn't brain surgery, but I was able to do sales, marketing, product development, distribution, logistics, and then, selling the thing at the end.
Who'd you sell it to?
I sold it to one of our customers' sons for his 21st birthday.
Oh, really?
Yeah, it was a 21st birthday present.
From one of your customers?
Well, yeah, it was his son that he was giving it to.
Yes.
Yeah, so one of our customers.
So one of your customers was like, this is a cool business. He's turning 21.
He's leaving this year. He's just graduated. So there we go. So
that's a great gift.
It was a great gift.
I would love to receive that as a gift. That's crazy.
It didn't endure though.
Oh, it didn't?
I don't think.
Well, maybe he didn't have the same sales capacity or capability.
Well, it's hard work, and you've got to be passionate about it. And so it was my baby. It was hard work, but I was seeing the results every day. And I was like, this is me. This is what I want to be doing for the rest of my life. And then when I got into the law firm, I had an allergic reaction the first day. I knew categorically that I was not built to be a lawyer. I knew it felt like prison for me. And I did a 2-year stint in prison essentially. And the moment my 2 years came up, which was my goal to myself to be a lawyer for a couple of years.
Right.
I went off and networked in the New Zealand startup ecosystem, found a mentor / business partner, and got into it.
Yeah. Did you start 90 Seconds?
I did not start 90 Seconds.
You have a track record of kind of coming in and like helping businesses go exponential, it seems?
I think one of my core skills has been in identifying entrepreneurs or founders at an inflection point.
Yeah.
So I love helping. I love entrepreneurs. I love the way they think and their limitless outlook on life. And I like to support them to grow ventures. And that was my first experience of doing that.
Yeah.
I bought 30% of that business though.
How did you do that?
Well, I'd been running a couple of different sales roles between the law and finding that opportunity. And I was earning commission off 2 different
nice.
jobs, saving every dollar I earned, and saved enough money to buy 30% of 90 Seconds.
Outright?
Cash, yeah.
Yeah, nice. And did they give you some preferential kind of rate on the shares, or did you have to pay market?
Preferential rate for sure.
Yeah, that's good.
Yeah, with a lock-in for 4 years.
Okay, which you did.
Which I did. I did 6 years there.
Yeah. And did you build and grow the sales team?
Absolutely, yeah. So grew the Auckland office, or transitioned from Wellington to Auckland, and then set up the Sydney office. And then we had managers and other, sort of owners grow throughout the world into different markets. So scaling a small sales team in a small market and getting the first $1 million of revenue is really my sweet spot.
Yeah. And then at that point, do you get like itchy feet, or?
I think I'm most valuable in that ideation through the first $10 million in sales.
Right.
Where there are no rules, the systems and processes and the first customers need to be designed and won. And I think for me, I have an optimistic outlook, and I see it as a challenge, and I enjoy creating the first pitch decks and networking and getting into the rooms of our ideal customers and proving a solution out. That excites me. And it's also where you make the most gains, from a very low valuation through to something that is actually real with customers and recurring revenue.
Yeah.
So I think it's actually a good place to play if financially into it.
Yeah, for sure. Do you often get someone quite operational in your team early then, if you're someone that's willing to kind of sell and break things, or do you have some of that organizational kind of?
I think my sweet spot is around supporting a founder and being a sales pillar.
Yeah.
And the founder can translate insights from our sales interactions into product enhancements and feature requests, and ultimately landing on product market fit.
Yeah.
Through that recycling of knowledge between sales conversations and product, and getting more and more and more focused on what it is we do, how we talk about it, and then how we sell it and scale it. I think my skill is in
that phase,
in closing that loop.
Right. And how long do you think it typically takes to find that solidify that product market fit?
I think no sooner than 12 months, and probably closer to 36 months across my 3 or 4 experiences.
Yeah.
But you can make sales the whole way, and it's really iterative.
Yeah.
And you can make gains and create momentum whilst not necessarily having pure product market fit.
Do you think there's a risk in trying to run too fast and scale sales too fast when you're in that phase?
Absolutely.
You want to grow your revenue, right, to show gains and to get that valuation, I guess, confirmation as a startup, but you also don't want to piss people off.
Yeah, I mean, you're constantly overreaching, 2 steps forward, 1 step back. You try and make fewer mistakes as you do it again and again.
Yeah.
But mistakes are a natural byproduct of iteration. And if you don't make mistakes, you're not going to be growing. You're not going to be learning.
Yeah, for
sure. Lots and lots of mistakes. Going into a new market too early, under-resourced, haven't done the research on that market adequately, hire someone who's not adequate for the job, you lose that person, you start at square one.
Yeah.
There's 1,000 different mistakes you can make.
Yeah. That's true.
But if you're fundamentally making sales every day, every week, every month, every quarter, that actually solves a lot of those mistakes.
Right.
Revenue solves all often.
Yeah. Even if it's not the most efficient revenue in the beginning, it's just validation.
Yeah, absolutely. I mean,
because your CAC in the beginning versus like maybe 2 years down the line is going to be dramatically different.
100%.
And perhaps the CAC it depends if you even choose to track it. I think it's quite good. Like we track it now. We know that our CAC is massively inflated, but we'll kind of get down to where we want it to be.
You've just got to get dirty and roll your sleeves up and win your first 10, 20, 50, 100 customers.
Yeah.
Because they're going to refer you to other customers, and your cost of acquisition is going to go down as you become a more established product.
Yeah, for sure. Yeah. So with your Cover Genius kind of saga, you said you did that as an opportunity to do your OE.
Yes, definitely.
So were they based here?
So Cover Genius was founded in Sydney in 2014, 2015. And I joined in March 2016 and was the first sales hire. There was 6 in the team in Sydney, and there was a small call centre in London with an insurance resource over there, a guy called Graham Dean, who I'm still good mates with.
Yeah.
So I flew into that market and had no idea around what insurance was. So essentially learnt a lot from the insurance lead over there. And we were going after a super tight niche market. So how they made money was designing a very focused product in the car rental excess waiver space.
Yeah.
And essentially enabling all of these car rental aggregators to design and sell an insurance product to go with the car rental sale that they'd made.
Right.
The bigger theme, though, that Cover Genius saw and knew was that e-commerce companies that sell a product in the shopping cart have an opportunity to offer an ancillary sale of insurance
right
at the same time. And the other insight was that you could learn from all of the booking path flow up to the point of that transaction to learn the potential for that consumer to purchase an insurance product. So they take all that booking path data and then dynamically price that product based on all of that learning. So it's quite sophisticated stuff on a really niche product in the first instance.
Yeah.
So there were about 30 car rental aggregators in the market. We sold into 25 of them, but we also had the 10,000 pound gorilla booking rentalcars.com as our foundation client.
Right.
And it was that mega client which attracted a lot of the second and third tier clients to give us very, very good exposure in that product.
Yeah.
But then once we'd really dominated the car rental excess niche, it moved into travel insurance and then warranty products for marketplaces like eBay or Amazon, and then into different lines of commercial insurance from there. So I think the learnings were go hard in a niche, win the big player, be global from day one, and then grow out your product suite with the fundamental understanding of that e-commerce needs to have an insurance product available as an ancillary revenue stream.
Yeah, that's cool. Yeah, and there's a theme, and it seems that you often have been basically business to business focused in your sales.
Definitely, yeah.
Is it easier? I mean,
don't
it's all
know.
hard.
I don't know. The only
don't know.
B2C stuff I've done is the Friday Fruit Box, which was...
But there's kind of one-to-one sales as well, which isn't too different from a B2B sales, right?
Yeah, true.
I mean, the key to B2B sales is your relationships, right? Like strong relationships.
Well, I suppose it's the ability to build rapport quickly.
Yeah.
It's understanding the person you're selling to and what their objectives are, and what their company's objectives are, and asking lots of questions and being a good listener, and then not being a cookie cutter salesperson, but really trying to make sure that what you have to offer is relevant for that person, and you do that over and over and over again. Yeah. You learn what the common objections are, and then you tweak your product to suit what the market wants and needs.
Right.
So highly iterative, but rapport building at its core as a starting point.
Yeah.
But then you run a good structured meeting, and then you have very good follow-up, and then you deliver what you say you're going to deliver.
Yeah. And
then you do it again and again and again.
Yeah, that's cool. And I think, do you think like boring's good in that case? You know, like you find something that, because like as an entrepreneur, you kind of want to find new things. But actually, once you get something that's working, you're like, okay, like I can spend X amount of dollars or X amount of effort doing this. Like, let's just keep going.
Extraordinary is a really good example. So we started as Health Now, making controllable allowances available for companies that looking to deliver health and wellbeing allowances. And what we discovered is once we'd sold in the solution as a health and wellbeing focus, the prospect or the company or the customer was often using us for corporate gifting or other allowances outside of health and wellbeing.
Right.
And that was a process of iteration and discovery that led to the rebranding to Extraordinary. And I think if we were laser focused on health and well-being, we wouldn't have seen the bigger opportunity.
Right.
So I think boring is good. consistent, repetitive is good, but also flexible and responding to the needs of the market.
Listen to the market.
Listen.
Yeah. How was that rebranding approach? Like, was that a hard process? You guys were further. We did a similar thing, but you guys were further along.
I can't take credit for the rebranding, although the conversation was was constant leading up to it. We'd actually gone down the path of a whole nother brand in the health and well-being focused area.
Right.
And as we got closer and closer to D-Day, we got further and further away from it, where we realized we needed to be more broad and more holistically focused on benefits, allowances, and corporate gifting.
Right.
And we found a definition, an accounting definition called an extraordinary payment, which pretty much perfectly nailed what it is that was our focus.
Right. Oh, nice. That's cool. And then the brand came from there.
And then the bright, colourful, extraordinary brand came from there.
Yeah, that's awesome. Well done. That's cool. And you guys do really well with your social. Like,
LinkedIn's our channel.
LinkedIn's
awesome. The channel that works best. So Steve our founder has, many thousands of followers, and is known to produce content and distribute it twice a day.
Nice.
And if you're up for following Steve and Extraordinary, you're going to get a lot of content from us.
Totally.
So it seems to work well.
Your reach is actually probably disproportionate from your, like, if you think about maybe 6 months ago, your brand had permeated more than most other B2B businesses would have at that stage in your life cycle because of that reason.
Yes.
And LinkedIn is money.
Totally. We get lots and lots of inbounds through DMs on LinkedIn. But, to make a sale, you need to be relevant for someone for a while.
Yeah.
And you need to have been seen in a bunch of different areas. So LinkedIn's really just the foundation. But we pay and attend, trade events in the HR and finance space to speak to our ICP directly.
Yeah.
Frequently, they've seen us on LinkedIn prior to meeting us in person.
Yeah.
We also do performance marketing, and we do outbound sales, and we do email marketing, and we do other social content.
Yeah.
But I think LinkedIn's the foundation from which the other marketing and sales efforts,
Do you pay on LinkedIn at all?
We do it. We've experimented with LinkedIn ads,
and
but
thoughts?
Not so much.
Yeah.
We're not that sophisticated on those ads. We talked about LinkedIn being the last free channel.
For now it is.
For now,
no, I like it, but I've thought about do I put some money into it? I mean, our engagement on our organic stuff's strong, but it's always an interesting one. I mean, we did it we did one piece when we were Gembot, and it was expensive. And our market we were nowhere near product market fit at that point, so we didn't know who our customer was. So we were shooting in the dark of, okay, is it worth it for us to pay that much for a lead? Now we have a really good sense of it, but I do agree that LinkedIn is the coolest platform to get growth on now at the moment. And even B2C, you can do it. You can do it. Why is VC broken? And aren't you in a VC-backed business?
I've interfaced with venture capital through those different businesses I've participated in different levels of involvement. And then obviously being a general partner in a small venture firm, there's the power law dynamic in traditional venture capital strategy where you invest in 100 companies, one might become a unicorn, and then a selection might make 2 to 5x, and some might return money, and a whole bunch will go to zero.
Yeah.
And I think that's not a great experience for portfolio companies if you're not part of that top 2% of the portfolio, or top 5% of the portfolio. I don't necessarily think the model is broken because I've seen companies.
I guess who's it broken for?
Yeah, I think it's for the 80% of companies that don't make it. It's broken for because the push in the venture management teams is for unicorn outcomes.
Yeah.
So they're not actually playing for the 2x return or 5x return over 10 years. So I think I'm seeing a contrarian viewpoint popping up more frequently, which is, well, we're not gunning for the power law outcome.
Right.
We're gunning for 5 to 7 times return across a higher percentage of the portfolio, and a bad outcome would be a 1 or 2x. And it just seems more rational for founders to not give away so much of their company and to have, I guess, less pressure to
spend,
to hit outcomes that aren't necessarily an option in the niche that they're going after.
Right.
Not every company can.
So you don't have to tell a story to
get 1,000 times exit. Yeah.
Yeah. But also, it's I think after 2021, you've probably got more of a fight. Well, you 100% have more of a focus on unit economics now across the whole kind of industry. And I always say that, if you're forced to, or you're encouraged to ramp up your spend really quickly, you become the Titanic, and then shifting out the way of an iceberg is really hard. Whereas if you don't turn the tap on too much, it's easy to basically rectify and kind of stay safe. Because I think actually a lot of the blow ups come from losing, right? You die. Like, if you don't die, you have obviously you have a much higher chance of success, even if you're currently going in the wrong direction. And a lot of companies basically end up blowing up because they don't have a solution for their predicament. So they get themselves into a runway issue or some sort of liability issue ultimately. And that's how most bankruptcies and all sorts of things unfold, is because there is a liability issue that you can't actually solve in time. And then that's when things end. So that kind of approach towards more kind of rational kind of growth and expenditure, not growth at all costs, potentially, is a trend that will now kind of probably last for the next 10 to 15 years.
Yeah, I think VCs are always going to look for the moonshot outcomes, but I think there might be a more blended approach in portfolio construction.
Do you think that equities have done better than VC? Because I've seen some data that shows that it has, on average especially.
I mean, I've always invested in equities in the last 20 years, and as well as startups. And I've always tracked the S&P 500 with a smaller portion of direct investments and had relatively good outcomes. But I think diversification requires different assets, and public markets are great and very liquid and quite safe if at an ETF level. So I would believe that thesis that public markets are safer than VC for sure.
Yeah, and maybe even get better returns.
Yeah, I'd believe that.
On average. Obviously, they're the outliers. But that's also the same in the stock market as well. The outlier companies are paying for most of the returns in the S&P 500, right?
Totally.
If you look at, Mag 7, for example, that's really where your returns have come from, or they've been the driving force behind much returns over the last 10, 15 years. So the winners always seem to, the cream rises to the top in a sense, right, in all industry.
And asset classes.
And assets, right? I do think you're right on that. And I think that diversification piece is important, because we were talking about it earlier that, you actually just feel the volatility more in equities, whereas you probably get the same volatility in property and in startups and private businesses, but they're not marked every day. You go, well, what's the health of your VC portfolio? You don't really know. You can put your prior raise marks on them, right? And you're like, well, this is where we're at, kind of, maybe. But if they were priced every day, the volatility would be unbearable for venture. And it just wouldn't work, because there's no people coming to startups every day being like, all right, I'll trade your equity. But, what you're getting in public equities is you're getting price discovery every single day.
Every minute of every day.
Yeah.
And what we talked about earlier before this was volatility is a price you pay for outsized returns.
Yeah.
And in equities, it's just more available. The data is more available every minute.
Which is great.
Totally.
Because I think that an asset of equities is actually the liquidity component. I'm not advocating for trading necessarily, but that liquidity optionality is awesome.
It's as good as cash.
As long as people turn up the next day to buy, right. As it's an auction-based system, but it's very close to as good as cash. Well, it's probably better than cash in some regards. It depends how you look at things. At least it's productive and it's doing something. It's not getting inflated and debased every single day. Coca-Cola is not being debased every single day. They're producing more. They've got pricing power, strong brand. That asset continues to deliver, and it pays crazy dividends. Buffett's receiving more in dividends every quarter now than his initial investment in Coke.
Wow.
Isn't that epic? And we were talking earlier about cash flow and how cash flow it has been underrated in New Zealand as well. I've done close to 100. I've probably done close to 100 of these financial well-being kind of exercises with people where we basically do the whole net worth tracking piece and track cash flow, do a forecast, etc. And the people that are not happy usually earn a shit ton of money, but they just have consumed too many financial products, and then they're less happy because they got less cash flow. The whole Munger thing of cash flow is oxygen. You're just happier when you can breathe.
Totally.
Right?
It just seems like a tricky segue in someone's financial life to transition from asset growth to cash flow growth. It seems hard.
Yeah.
But you have to start somewhere.
Yeah. Your early dividends seem silly, right? The dividends that Buffett would have been getting when he first invested in Coke would have been unsubstantial.
Even buying a rental property, it's 3% yield, 5% yield, 7% yield. It's not a lot of money for an outlay.
No. Yeah, and you're putting in a lot of capital that's then illiquid as well.
Exactly.
So it's tough. But like you say, it's about being a little bit strategic about it and having really strong ideas of what you want out of an investment or a financial product. What do you want out of this insurance that you're buying? So let's say you're buying insurance protection, income protection, and then you have a revolving credit line on your mortgage. Are they doing the same thing? Because you could be paying basically twice. And I think when you scrutinize any financial product or, essentially liability that you're putting on yourself, you just want to be okay, why am I doing this? What's the objective? What's the strategy? How does it interplay with the rest of my portfolio, the rest of my assets, the rest of my liabilities? And then you can make a clear, a clear decision. Whereas if you're kind of coming at it from a fear and a quick purchase piece, you can be oh yeah, I need income protection. And then you go to do the mortgage and oh yeah, I'd love a revolving credit because I'm worried I'm going to lose my job. Forgetting that the fact that 3 months ago you got income protection.
True.
And then that combined cost is premium of $1,600 a month, maybe. I don't know. And you're oh, okay. So I think New Zealanders need to consume less financial products, although this isn't financial advice. But I think less is more. And I think that's a really kind of good place to be. And then you put yourself in a position where you can't blow up. I often think about, I don't want to invest in banks for myself personally, because banks can blow up overnight. They have blow up risk. And I'm I'll probably be net happier if I just invest in assets that don't have blow up risk. So they don't have any debt problems. They potentially don't have trial problems where they might be going for some sort of FDA approval. And it's all hinging on some patent or some FDA kind of, or regulatory kind of approval that kind of then can turn the value to zero. So I'm kind of as time goes on, I become more and more boring, and I'm just like, yeah, I'm kind of. It's really interesting because you gain scars over time, right? And you're like, oh, that hurt.
Well, looking at some of these portfolios that you track in the Acuity platform, you know, Buffett's portfolio has what, 20?
Well, total, but we have the top 10, and then his total portfolio I think it's like 39 holdings.
39 holdings, and that's for one of the biggest investors in the world. It's not a huge number to track. And then some of the other portfolios have three ETFs, and outpacing the benchmark. So.
Well, it's like it's like Netflix and chill. It's like dollar cost average and chill. Like just do that and have different. I like the idea of being strategic with it. Like, so, okay, I like the idea of having perhaps some exposure to fixed income bonds, and then working out why would I want, why would I actually want exposure to something. Yeah, so we've spent a bit of time talking about your objectives with your own kind of wealth. And I think you've kind of gone on this journey of like highly illiquid, high value, high kind of trajectory, like asset classes and equities to like broadening it. And what was there an aha moment with that?
I think I could probably go back to the start of it.
Yeah.
It was 2007, and I invested in a really crappy stock, which was Halliby's.
Okay.
It was an old-fashioned investment company, and I sat on that for 15 years, and I returned I think I lost money over 15 years just because I wasn't involved in it. It was just interesting to have that in my portfolio just to see what it did, what a bad stock would do. And then I re-entered buying Xero at $12 and sort of have still got that in my portfolio now.
Yeah.
It was most recently at 180 and sort of has dropped since the tariffs. But from there, I got into Amazon before they really popped, and then the other Mag 7. So the Googles and the Netflixes and the Microsofts and the Teslas and things. And then I started building out the ETF component. The S&P 500 over the last 15 years has been an incredible buy and continues to give me outweighted performance with very little risk. So that's the sort of really boring, simple portfolio construction that I've taken and have just stayed with it. And the returns have been pretty good.
And that then creates a high bar for then buying something new.
Very much so. So you gave me a really good lens when thinking about crypto. So I'd built a position in crypto across Bitcoin and Ethereum, and plan to hold it forever. I think it's going to be an asset that continues to go up in value. So that was a new entrant into my portfolio. It's not an individual stock, so to speak, but I kind of see it as similar.
As a component.
As a cornerstone component to my portfolio that I'd like to continue buying.
So what is like, I guess, you set a load of seeds in the past of, you've got a bunch of assets that are more illiquid. You set those seeds, they're germinating, they're growing, and, you're just going through life, kind of planting some new seeds, moving on, planting new seeds.
Yep.
What does 5 years look like for you, like in terms of success?
I think since I had my first liquidity event, I've done exactly that. I've just continued to plant seeds. So whether it's working and investing in a new tech venture, or setting up a venture capital firm and getting share of carry, or buying property, or investing in the stock market, I've just continued to plant seeds. And I think what I've realized over 5-10 years is that you can reap the rewards of that and harvest those seeds when they've grown into something tangible, and then you can redeploy. So I've had a few positive outcomes, and I'm looking forward to redeploying and planting more seeds, essentially.
Yeah.
Yeah.
That's cool. And that's just a lifelong thing.
Totally. Things cross my desk all the time, and if it's interesting, I'll take a look at it and have a go.
Is that underrated, like the ability to get those things come across the desk? Do we not spend enough time thinking about how do you be a great deal maker or a great individual in an ecosystem so that people come to you with things that aren't necessarily on the market or are giving you insights freely because maybe you give back?
I think it's the same as like the sales chat that we just had. You've got to try a bunch of things and put a bunch of bets out there to truly learn.
Yeah.
And that's one of the benefits of growing older. You've tried a bit more and seen a bit more. So you have a bit more pattern recognition when something good comes up.
Right. Yeah, totally. And then just in terms of like, I kind of just want to lean on this because I just don't think it's talked about enough. And I think that there's a huge amount of wealth to be gained from it because I see really strong salespeople as well in Mag 7 companies, and they kill it. They make good salaries, they make commissions, and they make shares, and it's like net easier and higher probability of becoming a millionaire probably than being a founder in those larger commercial deals. I'm like, man, those guys they're basically not getting as high an income, but they're getting blocks of capital, liquidity events that then if you deploy that, you're not tempted to kind of let it flitter away. Like, when you're getting a good salary, maybe your expenses just go higher. But if you're a little bit lower, but then you get liquidity events, and then you force yourself to get rid of that liquidity event and plant some seeds, you're going to end up pretty well off. So from the lens of, okay, maybe I'm not starting something, but maybe I'm a really strong salesperson and I want to build wealth. I want to build equity. How do I hack my way into getting those windfalls and equity places? Like, what do you think from that perspective? Because there are a lot of people with great interpersonal skills, great sales skills, and they can make a lot of wealth for themselves by utilizing those two skills.
Often those people are inherently commercial and are looking for opportunities because that's in their makeup.
Yeah.
So I'd preface it with that.
Yeah.
I'm over 40 now, and a lot of my law school buddies are now partners in the biggest firms in the country and making bank.
Yeah.
And I've taken a different route. It is way more lumpy, and liquidity events come along, less frequently than a 2 weekly paycheck.
Totally.
And I think that's just a way of life. That's just a difference in how we approach, wealth creation. But I think the salesperson you refer to is probably a pretty commercial person that's looking to plant seeds more regularly.
And do you advocate for cash commission or equity commission or a split of both?
Well, I always work better personally if I've got skin in the game.
Right.
I'll sell the thing like it's my own, and it is.
And it is, yeah.
So I always would say, equity and shares and options interest me.
Yeah.
But equally,
you were saying it earlier. Bird in
the hand and commission and cash is fantastic too. So it depends on what your risk appetite is, what your life stage is, and what your commitments are outside of it.
Do you think go and do door-to-door sales as a good step?
Maybe. I mean, I don't see myself as a dyed-in-the-wool sales guy. I see myself as someone really interested in business.
Yeah.
Who's talking from one business owner to another. And if you're passionate about business and what goes into building a good business, then you're going to do pretty well in sales.
Yeah, because you kind of have this appreciation for the difficulty. You are interested in business, so then you want the best outcome for the potential client. And then the client feels more comfortable with you and is like, they want to see me win. They're not just worried about a transaction.
It's also about authenticity. Yeah. For me, like I always kind of cringe at the thought of being seen as just another sales guy. For me, it's about being authentic and showing my full self or true self in every situation, and that sells too.
Yeah. Yeah. That's awesome. Well, thank you for coming on the pod.
Welcome.
I really appreciate it.
Thank you.
It's been fun. And till the next time.
Awesome.
Cheers,
Cheers,
mate.
Jade.